Good afternoon and a very warm welcome to you all. My name is Barrett Palmer. I'm the MD of the UK and EMEA region for Mesh Experience, and I'm joined by my colleague Mark, who's Experience Director here. This is the third in a series of webinars where we've been looking at our UK retail banking study, looking at the last year's worth of data that we've collected and delivering insights on the back of that. This particular presentation is about, within the context of the rise of challenger banks and the series of IT glitches that we've experienced over the last year or so with certain banks, why it's important for retail banks to build a perception of innovation and also reliability. The presentation's in two bits. The first bit is where I'll give you an overview of our philosophy and an insight into how we've collected the data. And then Mark's going to take you through the actual particular presentation regarding innovation and reliability. So our whole premise is based on a very simple thought. We're all based around experience-driven marketing. The simple thought is that in order for us to really understand how brand perceptions are being built, we need to understand every interaction a customer has with a particular brand. Whether that be online, whether that be talking to someone, whether that be through a TV ad. It's a combination of all those experiences that builds perception. And that particular view is resonating with senior marketers in all kind of companies. On the right is a quote from Mark Pritchard, who's the Chief Brand Officer of Procter & Gamble, who are turned on to the fact that it is the total consumer experience, every aspect of that consumer experience that marketers need to be in charge of and responsible for to drive brand metrics and also to drive brand growth. So in order to understand how consumers are experiencing our brands, we need data. And at the moment, as marketers, we're awash with data. We call it big data. We're collecting data and metrics in silos. We're looking at GRPs from one source, looking at click-through rates from another source. Our media agencies is telling us about share of voice. And when you've got data coming from disparate sources, sometimes it's very difficult to kind of make sense of it and to get a real understanding how consumers are experiencing our brands and how those experiences are shaping brand perceptions. So at Mesh, what we've done is we've put the consumer right at the center of our data collection methodology, so that it's only when you look through the experiences through the customer's eyes in the real world, understanding what they're picking up and when they're picking those up and what their emotive response to those experiences is when you start to really understand how what we're putting out is being picked up and how that's shaping customers' perceptions. So the principles of our approach is really simply moving from a disparate and disconnected source of data to a unified world where you're viewing your data through the customer's eyes in the real world. So we're understanding what's important to customers, what's actually reaching them. So it's not just about what are you putting out there, but what actually are customers picking up? What impact is that having on customers? And within the context of how do your experiences compare with the experiences that your customers are having with your competitive brand within the category, and how your competitors' customers are experiencing your brand in that category as well. So a bit about how we collect the data. It's an ongoing study. We recruit from a panel, which is general population, and at the beginning of the month, we recruit 400 people every month. And the first part of it is that we ask a pre-survey whereby we're trying to capture how people's current perceptions of a brand, of all brands within a particular category are. So in this case, it's retail banking. And in that survey, we capture the usual brand health metrics and image statements. And then with those customers, we ask them to keep a mobile diary for the next week. And we ask them to look out for any brand experience that they've had with any retail bank in that week, and to tell us about that experience. Whether that be a TV ad, whether that be a call to the call center, whether it be accessing the online app. And we collect over 100 touch points. And when they've had an experience, we ask them two basic questions. First is, how did that experience make you feel? So we're looking at the emotive response to that particular experience. And the particular question we ask is, how positive was that experience? And we ask them on a scale of 1 to 5, where 1 is very negative and 5 is very positive. And then the second question we ask is, as a result of that experience, how likely are you to consider that brand in future? And again, we term that as persuasiveness. And at the same time, we also ask them to give us a kind of verbatim comment which describes the experience and helps us to understand why that particular experience was positive or negative, or persuasive or non-persuasive. And then after the week, we then survey the participants, and the survey is very similar to the pre-survey. We ask, again, the similar kind of brand image questions and brand health metrics, and that allows us to see whether there have been any changes in what they thought before the experiences they've had, and how they feel about the particular brands after the experiences they've had. So we're able to detangle which experiences are driving which metrics. And as a result of our thinking, we've kind of derived a very simple model. We've been running real-time experience tracking for 12 years, and over the years, we've really understood how to grow a brand as a result of driving experiences. And we know that the share of experience, i.e. the number of experiences your brand delivers within a category, is a better correlator with share of market than is share of voice. So therefore, with a lot of clients that we work with, we're working with them to help them drive their share of experience. But it's not just all experiences that we need to be aware of. We really need to drive positive experiences. And it sounds very glib to say that, but the data consistently shows that a positive experience is 3 times more impactful on driving a brand metric like consideration than is a neutral or a negative one. And experiences are driven in channels, and the methodology allows us to cover all channels in paid, earned, and earned. And through collection of the data, we now understand which channels are particularly positive, but also how within those channels do you drive a positive experience. And within those experiences, what are the propositions that really drive positivity? What placement drives positive experiences? So there are nuanced differences between where you place an ad. So for example, we understand the nuanced differences between running a proposition in a 6-sheet poster versus a 9 to 6 sheet poster, and which propositions work best in those formats, as an example. And then as well as placement, there's also context, timings, and competitors. So what else is happening in the world that could be affecting your brand's perceptions and your competitors' perceptions? What are the timing? When is it best to run your advertising, for example? So we know that financial services advertising works better in the evenings than it does in the mornings. And then all this is within the context of your competitors. So that's kind of the brand growth experience model and methodology. I'll now hand over to Mark, who's going to take you through the rest of the presentation.
Thank you. Okay, so what we're going to talk through today, as Barrett mentioned, was looking at some of the key drivers of innovation reliability. And this is based off the annual report that we pull together every year. And that looks at a full year's worth of data from April to March. So April 18 to March 19. And across that time period, because we're collecting experiences consistently every week, we build a database of over 25,000 experiences within that year. So that gives us a really robust data set to look into. And we then mine that data to see which touch points are people experiencing. So which touch points are people picking up and interacting with in the real world. And within those touch points, which brands or which banks are doing best at delivering positive experiences for customers or for prospects. So some of the previous webinars, we've looked into those different factors. And what we're doing here today is taking one of our advanced analysis techniques, which we call Experience Maximizer, and we're understanding, if we look at the two kind of key outputs of innovation and reliability, which are the touch points that we see at a total level has the ability to drive this? Which are the touch points that are currently working to deliver these key metrics? So we'll go into that, but I think before we go into the actual kind of drivers of these two metrics, I think it's worth understanding why we decided to look into these two kind of key outputs. So last year we focused more on trust, and I think even though it was kind of 10 years since the financial crisis, trust was still a really big factor, and still is, and still kind of will be always for banks. But actually, when we looked at the kind of 4 years data from April to March, we found a lot of different themes that were coming through related to either changes in society or events that were happening, or changes in the banking industry itself. So, for example, there was a lot of uncertainty, partly related to Brexit, which was around insecurity and instability. We saw that online banking was, as ever, increasing in terms of how people were interacting with it, and those systems were becoming more kind of complex, and with that higher reach and that more interaction, more important. We saw a range of technological innovations that were coming through. So some were around pure innovation within the sector, and others were related to more communications and making customers aware, or shaping some of those innovations to be really customer focused. And obviously we continue to see smaller banks and challenger banks, especially the fintechs, take advantage of some of those innovations and opportunities. So this was some of the broad context which we started to investigate. And I think breaking those themes down, we saw increasingly in the most recent annual report, branch closures continue to kind of increase negativity around the banking sector. We saw throughout the year, Santander, when it announced a range of bank closures, suffered a lot of negativity. And here are examples of what people actually say when they have these experiences. So for HSBC, kind of very disappointed that they're no longer able to speak to a real person to resolve some of their issues. And someone, what they say about related to Barclays is that actually this is not the first bank that they've closed in their town, and actually understanding from a customer's perspective what that actually means to their town and society. So again, we saw a lot of this as banks moved more towards focusing on online banking and digital, and we saw branch closures. That was, of course, an area of negativity for a lot of customers. But equally, when we look at the number of online banking and app experiences, that has grown over the last few years. But that's not without its own negatives. So in particular, what we saw last year was the IT glitch from TSB, which created huge levels of negativity, both from customers in the first instance, not being able to access their accounts or withdraw money, but that was then exaggerated or picked up again through earned media sources. And actually what we're looking at here is the earned media negativity. You can see from kind of March, April, May through to June, that negativity kind of maintained at a really high level and was sustained for a lot longer than just the glitch itself. So there are a lot of obviously risks as well, moving towards more of an online banking digital focus. And again, that can cause a lot of mistrust or upset for individuals, and can be picked up and kind of exacerbated through news sources. In contrast to that, though, we saw a lot of positivity related to new product development, new communications, and, as we said, new entrants. So, for example, NatWest, we're talking about piloting new fingerprint technology instead of people using pins. And again, some of this innovation, whilst it was not picked up through the kind of immediate own sources, as it was something to think about in the future. Again, it helped to drive a lot of positivity for the bank through earned media sources, with people thinking that they are an innovative bank and kind of looking towards the future. Similar, what we saw from Barclays was a range of different product innovations or product applications which allowed them to show how they were using some of this innovation, these new techniques to help customers. And a good example here of using the payment calendar to check, when they have money and when payments are going out. And again, these kind of new innovations and new ways of using the category really help to drive that positivity. And similarly, in the middle, we saw again increasing challenger banks and Monzo starting to use paid media and advertising to increase its reach and to get people to know about the bank and about what it can do that's different to your kind of standard bank. And obviously, putting forward the message that it's the kind of future of banking. And on that same note, when we look at the rise of the challenger banks, which we touched on in our last webinar, we saw that firstly, the share of challengers was increasing overall at the total level, so they were representing a larger proportion of banks. But even more interesting is if you looked at their share of positive experience, that was increasing at a faster rate. So what that means is if you look at all of the experiences within the banking sector that are positive, the challenger banks are starting to bite away at that and increase their share among that, showing that they are generating those really positive experiences within the sector. So because of those two factors, we felt that we had, on one side, there was the innovation about moving towards more digital for the new products and new developments. And on the other side was the reliability question around some of those changes in innovation and around some of the fundamental questions within the banking sector. Is it reliable? Can I trust that bank with my money? And ultimately, those two can feed off each other. So more innovation within the sector, so increased security, can feed through to make people feel more safe and the bank is reliable. But at the same time, if there's any negatives around the innovation, or if there's any problems or issues that come about as a result of that innovation, again, that can damage a bank's perception of reliability. So there's an interesting kind of trade-off between the two, which we'll explore further. So we just want to touch on a few points around what do those reliable information perceptions mean for the banking sector, and who is currently performing well within that. So fundamentally, as Barrett said earlier, what we believe at Mesh is that you want to be generating more experiences to increase your share. And within that, you want to be generating positive experiences. And this is fundamental to what we believe and what we see. So when we look into the data, we can understand if an experience is positive, neutral, or negative. And what we're doing with these charts is we're mapping out the ability for those different experiences to either create or maintain consideration. And we're looking at customers on the left and prospects on the right. And we see both for customers and prospects, if they have a positive experience with a bank, they are much more likely to either become a considerer or stay as a considerer of that bank versus a neutral and negative experience. So there's a really big difference. So between negative and neutral, actually, there's not as much of a difference between a neutral and positive. So this is why we say if you want to build consideration, if you want to move your brand forward, you need to maximize the number of positive experiences you're generating. But rather than just being for consideration, we've looked at this across a range of different measures. And again, if we want to generate or improve reliability, so improve the perception of reliability or improve the perception of innovation, again, it's about fundamentally delivering positive experiences. So above all, regardless of channel, if you can generate, if you are delivering those positive experiences to customers or to prospects, they're more likely to become or endorse you as a bank for being reliable or innovative. So kind of a fundamental there about what we believe and what we need to do as a base to generate and to improve these perceptions. And in terms of how important they are, well, we looked at a range of different statements related to service, to trust, to innovation and reliability, obviously. And we found that if we look at those who are considerers of a bank, we find that 85% endorse that bank for being reliable. So it's a really key metric that people want to have and want to say about the bank they consider. So really, it's needed in order for people to become a considerer, and a really strong measure. And in terms of innovation, when we looked at considerers versus non-considerers, considerers were more than 2.7 times more likely to endorse the bank for innovation versus non-considerers. So again, reliability is such a strong metric that is kind of fundamentally needed. And innovation is something that if we get people to think that a bank is innovative by what they deliver and how they communicate, people are much more likely to then consider that bank other than they otherwise would if they didn't think they were innovative. And we looked at the kind of top banks and grouped some in terms of just image statements benchmarked versus the average, to see who a general perception level is currently performing well for innovation and reliability. Nationwide, followed by Halifax, came out in top versus the market for being seen as reliable. But comparing that to innovation, we see these are much lower, so still above the category average, but much behind where the levels of innovation are. Someone like Barclays, for example, whilst it's not as strong for reliability, has a stronger mix overall of being seen both as innovative and reliable. And at the other end of the scale, we see banks like First Direct, for example, which is seen as more innovative versus the average, above its level of reliability. And interestingly, when we look at the fintechs, really strong innovation perceptions above all other banks, but actually reliability much behind. So whilst they are seen as really innovative, there is a need for them to improve their perception of being reliable, which will obviously come with time and that ability to build familiarity. But this is the current picture that we're seeing. So moving on to which touch points we use and how we can leverage different media. What we are looking at here, again, is taking the entire data set over the year and looking at if we see any changes in someone who didn't, at the start of their diary week, they didn't think a bank was reliable. So they didn't endorse a bank for being reliable. And at the end of the week, the same bank now endorse them for reliability. So we see there is a change in the positive direction from not thinking a bank is reliable to reliable. And then what we want to understand at a very top level, which are the experiences within that week and which are the touch points that have caused that change. And we've done this for prospects and for customers. And I've just picked out 3 here, and because these feature for the list among both prospects and customers. So we see that a branch experience broadly, so any interaction with a branch, means that a consumer is 1.45 times more likely, or a prospect is 1.4 times more likely to become a reliability endorser for a bank. So that branch experience, in a sense, is helping to create the perception of reliability. Similar for a website experience, so someone who's had a website experience versus someone who hasn't are more likely to improve their perception of reliability for a bank. And similar for online advertising. Now, there are some other ones which I haven't gone into here. So, for example, for customers, TV experiences and out-of-home advertising experiences actually can, and what we've seen at the overall level, have increased the perception of reliability. And for prospects, actually things such as social media and radio advertising have. But I focus on these because they are consistent across both groups. So any of these experiences at a total level we see have been able to build the perception of reliability. Going into some more detail then, so when we look into branches, we map out how well each individual brand performs for a branch experience. And this is based on our 2 key measures of positivity across the horizontal axes and this is top 2-box positivity, so very or fairly positive. And on the vertical, the persuasiveness. So did it make people slightly more likely to choose or much more likely to choose that brand in future? So we look at those two key measures and overlay that with the number of experiences, so essentially the reach of that bank. And we see that out in front for one of the major banks is nationwide, so really strong in terms of how its quality and its persuasiveness of its experiences. And we see a lot of really positive feedback where people have nationwide experiences. And a lot of it is related to the kind of friendly atmosphere, the speed of the service, the community feel it brings to them and to the bank. So it offers that, in a sense, that stability. It gives a presence to a high street or community, and really fundamentally, it gives that human interaction. And all of this helps to build the sense of reliability and that stability within the bank. Now we do see some smaller banks such as M&S, Cooperative and Metro as well generate those positive experiences. So again, in that really kind of key space of delivering excellence and therefore helping to generate that sense of reliability. And as well from a website, we see a similar picture that Nationwide performs really strongly here. And again, the website, similar to a branch, it offers that place where people can go to, they can visit. It offers that sense of, there's a place I know where I can go if I want information or if I want to, check things or look at some certain financial products. So again, it's that place, and I think it helps to reinforce the brand's nature. So, even within this, obviously, Nationwide, in its communication, in its positioning, generates a more sense of reliability anyway. So that's kind of reinforced through the website experience. And while some banks might have a more innovative web experience, ultimately, if we take all of that out of the question and we look at what is a website experience doing, so someone who has a website experience, that does improve reliability at a top line level. So regardless of what you communicate within that is helping to drive that sense of reliability. And finally, what was interesting is that online advertising, again, at that total level, we find online advertising increases that perception of reliability. Now, within that, there are going to be differences. So depending on what's communicated will work stronger. Not saying it will happen for every single kind of campaign or advertising. But again, when we've looked across the year and we looked at all the advertising, online advertising experiences, we do find a correlation and a statistical correlation between online advertising and improving reliability. And we've just looked here at a couple of examples, one from Lloyd's, where we see that the bringing across that by your side messaging is really helping it to build that reliability. And for Barclays, where it's communicating about safety and fraud, again, those types of messages which can engage audiences online are really good at improving reliability. When we looked at innovation, so some of the same experiences, such as branch, again, did help to reinforce the sense of innovation. And similar, when we looked at customers and non-customers, there were differences. So again, radio and social media was really good for prospects. And something like a call center, again, could help the perception of innovation for customers. The two that, again, appeared within both sets was an online banking and app experience and TV experience. Online banking, that's going to be much more present among customers, obviously. But there are occasions where prospects have gone online to experience the banking, or maybe they've experienced their friends or family's banking app. And whilst that is small, it does have a strong impact. And similar to TV advertising, it doesn't work for every single measure. But again, when we're looking at innovation at that top line level, it is able and has improved the perception of innovation. And some examples of this we've seen within TV advertising, for example, Barclays, especially more recently in terms of in 2019, have used that channel to strengthen on its already benefits as a touch point, to communicate some product innovations and some product developments which really help their customers. And delivering this in quite a clever and amusing way has meant that they get across the message in a really convenient channel, but also that it makes it really positive. And similar from a online banking perspective, that helps to reinforce. It's a touch point. It's one of the biggest touch points we see in terms of how people experience their banks. So it's a really strong touch point, and generating really really positive experiences which help people feel in control, give them information, keep them up to date, help them manage their finances, and quickly access all the information in one place. Really helps to reinforce that message over time, and really helps them reinforce that sense of innovation within that touch point. So there are lots that we haven't covered off in terms of additional touch points that kind of go into this, which we'll explore more in the annual report. But just to finish, we have a few top tips around how to deliver and drive both innovation and reliability. I think firstly and foremost is deliver positive experiences. So regardless of what we're trying to increase, whether that be consideration, innovation, or reliability, a positive experience is the way to do that. It's important to measure in context of both what competitors are doing, but also in terms of across channels. And we've often seen the case that whilst innovation hasn't ultimately been delivered through a piece of communication or through an actual owned experience, it can be picked up within the media and through that, or word of mouth, actually reinforce and strengthen these perceptions. We saw that owned assets in particular are really strong or really important to strengthen reliability. So the website and branches give a place and a presence that people can seek out to find out information and get that experience. We saw that online banking is a really key touch point, so one of the biggest ways people experience the brand. And that has a significant impact on reinforcing and building the perception of innovation for brands. Ultimately, as we saw earlier, that needs to be reliable, because any kind of glitches or security breaches can again undo that sense. And finally, we found interestingly that TV advertising generally builds the perception of innovation, regardless of necessarily the message of the brand. But within that, there are certain brands which have succeeded better. So Barclays, as an example, we use, increased in terms of going up our rankings this year. And part of that was to do with the clever communication about how they're helping customers with these new products and developments. So hopefully that gives you a bit of an understanding of what we're looking into for the annual report, and some learnings there around how we use the data and what we look into. So I'll just pass over to Barack before we finish.
So thank you very much for listening. We hope you enjoyed the half an hour that you've kindly given us. If you have any further questions, our contact details are on screen at the moment, so please feel free to email us with any questions that you may have. And we will also be posting this presentation online on YouTube, so you can access it at your own leisure. And we will be sending out links to the people that have registered to be here. So that's it from us. Thank you very much, and hopefully see you soon. Take care. Bye-bye.
Thank you.